Okay, let's unpack this. Imagine holding the balance sheet of a billion-dollar multinational conglomerate.
Oh, yeah, the massive ones.
Right. You are looking at the cash flows, verifying the asset columns, and, the bottom line shows record profitability. It looks engineered to absolute perfection.
Soluble, dominant, totally clean.
Exactly. But then you look closer. You realize that, I don't know, 40% of those assets are locked inside unaudited foreign subsidiaries.
Buried in opaque jurisdictions.
Right. And another 20% of the revenue is generated by this massive web of special purpose vehicles that don't even use the same accounting framework as the parent company.
Yeah, that clean diagnostic lens is just completely shattered at that point.
Completely shattered. You aren't looking at a financial reality anymore. You're looking at a highly curated, heavily filtered approximation of reality.
Which is terrifying for an auditor.
Totally. How do you, as an auditor, sign your name to that? How do you guarantee to the capital markets that this sprawling corporate behemoth is actually solvent?
It is the absolute definition of diagnostic muddy waters, really. Because when you evaluate a holding company with, dozens of subsidiaries, joint ventures, associates spread across entirely different regulatory jurisdictions, the truth of their financial health just becomes incredibly obscured.
Obscured by the sheer complexity of the corporate web.
Exactly. You move from this state of binary financial verification into a world of probability, risk assessment, severe scope limitations.
All right. The standard tools of financial analysis just start to break down if you don't know the specific rules of consolidation.
They absolutely break down.
And deciphering those rules is our entire mission today. Consider us your specialized academic tutors for the next hour or so.
We're glad you're here with us.
Yes, you, the listener, are stepping into an advanced masterclass right now on the intricate and, frankly, sometimes totally bewildering mechanics of group audits.
It's a dense topic, but a vital one.
Very. We are going to deconstruct the regulatory compliance, the consolidation exemptions, and those cross-border financial reporting frameworks that govern the largest companies on Earth.
Yeah, and our source material for this deep dive is a highly technical set of case study scenarios.
It's heavy stuff.
It is. It covers the SEBI listing obligations and disclosure requirements, so the LODR regulations, along with standards on auditing. We're talking SA 600, 705, and 706.
Plus the accounting standards, right, in AS 110 and AS 10.
Right, exactly. It is a heavy, dense stack of material. But we are going to decode these high-level audit scenarios together.
We're acting as your mentors here to help you truly master this material.
And to do that, we'll construct highly specific, elite-level memory techniques and mnemonics to ensure these technical requirements actually stick with you.
For your compliance reviews or executive briefings, whenever you need them.
Yeah. And per our mandate, we are keeping our analogies strictly within the realm of finance today.
No simplistic comparisons.
Right. No car or house analogies. We are looking at this strictly through the lens of capital markets, underwriting, and asset valuation.
Because why should you care about this? Mastering group audits isn't just some regulatory box-ticking exercise.
Not at all.
It is the fundamental key to understanding how corporate behemoths legally structure themselves, how they dictate their earnings to the public markets, and, historically speaking, how massive financial frauds have been perpetrated by obscuring liabilities in unconsolidated offshore entities.
Oh, absolutely. I mean, if you want to understand the modern corporate financial system, you have to understand the mechanics of consolidation.
So let's start at the very baseline of corporate structure.
Right.
Before you can even begin to audit a sprawling corporate group, you have to define what actually matters within that group's architecture.
Yeah, because a holding company might have 100 subsidiaries, but you cannot realistically audit every single one with the exact same level of scrutiny.
The audit fee would be astronomical.
Astronomical. And the timeline would be infinite. You have to establish a threshold. You have to start by defining materiality.
Materiality. And our source material provides a really brilliant, granular case study to explore this exact concept.
The Muksh Ltd.
Right, Muksh Ltd. We have a listed holding company, and according to the case, it possesses 7 distinct components, which are its unlisted subsidiaries.
Okay.
Now, 5 of these components, A through E, have been audited by their respective local auditors.
Sure.
But 2 of them, components F and G, remain unaudited. And a firm named Sambhav & Co. acts as the principal auditors for the master group.
So we have a listed parent, 7 unlisted subsidiaries, and the first major hurdle is figuring out which of these subsidiaries actually, move the needle for the parent company's survival.
Right. And the source gives us the critical macro data required to make that assessment.
What are the numbers?
We have the consolidated income of the group, which sits at 600 crore, and the consolidated net worth, which is 1,600 crore.
Okay, so those two figures are the anchors for everything that follows.
Yeah.
They bring us directly to the SEBI-LADAR regulations, specifically Regulation 16C.
Regulation 16C.
Right. This specific regulation dictates that a material subsidiary is one whose income or net worth exceeds 10% of the consolidated income or net worth of the listed entity in the immediately preceding accounting year.
A flat 10% threshold.
Exactly.
So let's run the math on the data provided for Muksh Ltd. Component A has an income of 70 crore.
Okay.
So 70 divided by the consolidated 600 crore gives us 11.67%.
So component A crosses the line?
It does. It is material. Component C has an income of 140 crore, which represents 23.33% of the consolidated total.
Highly material.
Very. Yeah. Component D brings in 130 crore, sitting at 21.67%, also material.
So components A, C, and D trigger that initial 10% benchmark.
Right.
And the regulation stipulates that once this threshold is breached, the listed entity needs to formulate a specific formal policy for determining a material subsidiary based on this benchmark.
Like an early warning radar system.
Exactly like that. It's an alert system for both the holding company's management board and the external auditors. It forces the parent company to formally acknowledge that a significant portion of its total value is now reliant on an unlisted entity.
But the source material immediately introduces a secondary layer of complexity here.
It does, yeah. Regulation 24.
Right. Regulation 24.1 requires that at least one independent director from the listed entity must actually sit on the board of directors of an unlisted material subsidiary.
Okay.
But here is the critical pivot. For this specific board seat requirement, the definition of material jumps to 20% of the consolidated income or net worth.
20%. So looking at our Muksh Ltd breakdown, only components C and D require an independent director from the parent company.
Because they were at 23 and 21%.
Exactly. Component A, which sits at 11.67%, triggers the first rule but entirely bypasses the second.
That creates a bifurcated system of materiality, which, often trips up analysts and compliance officers.
Oh, constantly.
You have two different definitions of the exact same word operating within the same regulatory framework, depending entirely on the action required.
What's fascinating here is the regulatory logic behind it.
Right. I mean, if I'm looking at a corporate structure where a subsidiary hits 15% of the consolidated net worth, it triggers the policy rule,
Yeah.
but not the board seat rule.
Yeah.
Why engineer a two-tier threshold? From a governance standpoint, isn't this structurally identical to, say, a minority shareholder having enough equity in a firm to demand voting rights on certain shareholder resolutions, but not quite having the requisite equity block to demand an actual seat on the board of directors?
Oh, that is a perfect, strictly financial analogy. Your shareholder equity analogy captures the structural logic flawlessly.
Thank you.
The regulatory philosophy behind this two-tier system is rooted in the distinct difference between passive transparency and active governance intervention.
Okay, let's break down that difference. Passive transparency versus active intervention.
Well, the 10% threshold is an alert mechanism. When a subsidiary hits 10% of your consolidated revenue or net worth, the regulator is dictating that this entity is now too large to be an afterthought.
Right.
The listed parent must formally acknowledge it, formulate a policy for it, and flag it in the disclosures as a significant contributor to the macro financial health. It is about ensuring the public capital markets know exactly where the holding company's value is truly being generated.
So it is disclosure. It is passive.
Exactly. You are basically telling the market, hey, keep an eye on this.
But the 20% threshold is entirely different.
Radically different. If an unlisted subsidiary is generating more than a fifth of your entire consolidated group's income or holding a fifth of its total net worth, that subsidiary is no longer just a strong contributor.
It's a load-bearing pillar.
Exactly. A critical load-bearing pillar of the listed entity's survival. If that subsidiary fails, the parent company collapses. Therefore, SEBI mandates active governance intervention. You must take an independent director from the parent's board and physically place them on the subsidiary's board to maintain direct operational oversight.
To prevent it from going rogue.
Precisely. It prevents the management teams of massive, unlisted subsidiaries from operating as unchecked fiefdoms completely out of the view of the parent's shareholders.
That makes profound financial sense. It scales the governance requirement directly to the systemic risk.
It does.
Now, to help you lock this bifurcated system into your memory, whether you are, sitting for an advanced compliance exam or drafting a risk assessment for a massive corporate client, we have developed a specialized tutoring mnemonic for this.
Right.
We call it the 10-dimension 20-to-direct rule.
The 10-dimension 20-to-direct mental framework is incredibly efficient.
Yeah, it's very clean.
If a subsidiary hits 10%, you mention it. You formulate a policy and classify it as material for passive disclosure purposes.
And if it hits 20%,
you direct it. You mandate an independent director from the parent to sit on that subsidiary's board for active intervention.
10-dimension 20-to-direct. It is binary.
Yeah.
And it prevents you from conflating the two thresholds.
Absolutely.
But our Mach Ltd case study is far from resolved.
Oh, we still have the black boxes.
Yes, we still have to deal with components F and G. As we noted, neither of these subsidiaries were audited by local component auditors.
Right.
The engagement partner for the group, CA Samhav, assesses the data and notes that component F is considered mathematically material to the consolidated financials, while component G is deemed not material.
Okay.
So how does a principal auditor navigate a landscape where a massive chunk of the consolidated balance sheet simply lacks verification?
This scenario forces a pivot away from SEBI regulations and directly into the heart of the standards on auditing, specifically SA 705 and SA 706.
Okay, lay it out for us.
The foundational premise of a multi-location group audit is that the financial information of all components should be subjected to an audit. When they are not, the principal auditor faces a severe structural limitation of scope.
You essentially have a blind spot on the balance sheet.
A huge blind spot. They lack sufficient appropriate audit evidence to back up the numbers on the page. You cannot verify the existence of the assets, the completeness of the liabilities, or the occurrence of the revenue if no one has audited the local books of that subsidiary.
And the regulatory response scales based on materiality.
That's right. Exactly. Let's look at component F. Because it is deemed material to the group, the lack of an audit fundamentally fractures the integrity of the master consolidated balance sheet.
Because it's too big to ignore.
Right. An auditor cannot legally assure the shareholders that the parent company's financials represent a true and fair view if a material subsidiary is just a financial black box. The risk of hidden liabilities or fictitious revenue is simply too high.
So what's the auditor's move?
Under SA 705, the principal auditor is forced to issue a modified opinion. Depending on how pervasive that lack of evidence is to the overall group, this could range from a qualified opinion to a total disclaimer of opinion.
I mean, from a capital market perspective, a modified opinion is a catastrophic event for a listed company.
Oh, it's the auditor's nuclear option?
It's like attempting to issue a clean valuation for a massive collateralized loan obligation, a CLO, when you have absolutely no credit data on the largest tranches of underlying corporate debt within the vehicle.
Spot on.
You cannot price the risk. You have to qualify your valuation, which instantly repels institutional capital. A modified audit opinion triggers debt covenant breaches, halts stock trading, and invites immediate regulatory scrutiny.
It is absolute carnage for the stock price.
Yeah.
But contrast that nuclear option with component G.
Right, the non-material one.
QAs have determined that component G is mathematically not material. It represents a negligible fraction of the group's income and net worth.
It is effectively a rounding error on the parent's macro balance sheet.
Exactly. Therefore, the lack of an audit for component G does not destroy the overall integrity of the consolidated financial statements.
Oh.
Even if every single number reported by component G was entirely fabricated, it wouldn't be enough to alter the economic decisions of the shareholders reading the master report.
But you can't just pretend it doesn't exist.
And no, the auditor cannot simply ignore it.
Yeah.
They must maintain absolute transparency regarding what was and was not verified. So instead of modifying the core audit opinion under SA 705, the principal auditor utilizes SA 706.
That's SA 706.
They add an other matters paragraph to the very end of their audit report. This paragraph serves as a formal disclosure, essentially stating, hey, for the record, this financially insignificant subsidiary G was not audited, but its exclusion does not materially affect our overall opinion.
The distinction is vital. SA 705 modifies the actual opinion because the unverified risk is material enough to threaten the entity.
Right.
SA 706 merely adds a sticky note of disclosure because the unverified risk is negligible.
That is the exact dividing line between a qualified report and a clean report with additional disclosures.
Which brings us to a massive overarching question regarding the actual mechanics of group audits.
Okay, what is it?
We have identified the components, we have applied our 10-dimension 20-to-direct rule to establish materiality, and we understand the severe consequences of unaudited black boxes.
Yeah.
But step back for a moment. If you are a partner at a major audit firm, stepping into a massive globally distributed group structure where dozens of other local auditors are handling the subsidiaries, how do you even determine if you can legally and professionally accept the job of signing off on the master consolidated report in the first place?
Oh, man. That is the most critical juncture in the entire process. The principal auditor's litmus test.
It's a huge liability.
It is.
Yeah.
And this is strictly governed by SA 600 using the work of another auditor.
SA 600.
Our source material illustrates this dilemma through the case of C.A. Tushar. He is evaluating whether to accept the statutory audit of a consolidated group that comprises a parent company and 3 distinct subsidiaries.
Okay.
However, all 3 subsidiaries are audited by separate component auditors, not by his own firm.
So C.A. Tushar is looking at this fragmented structure and asking himself, am I actually participating enough in this overall financial ecosystem to justify putting my firm's name and my firm's legal liability on the consolidated report?
Exactly.
The structural dynamics feel identical to stepping into the role of a lead underwriter for a massive syndicated loan.
Okay, explain that.
Well, in a syndication, you are organizing the capital, but participant banks are taking on large tranches of the actual debt.
Right.
As the lead underwriter, you need to know exactly what level of risk those participant banks are bringing to the table before you stamp your institution's name on the master credit agreement. The lead underwriter holds the reputational and legal liability for the entire package.
That underwriter framework perfectly encapsulates the liability matrix of SA 600.
It does.
Yes. The principal auditor holds the ultimate, undivided liability for the consolidated audit report. There is a terrifying risk in global finance known as rubber stamping.
Oh, I've heard of that.
It's where the principal auditor simply aggregates the component auditor's reports, assumes they are accurate, and signs the master consolidation without performing their own rigorous due diligence on the macro structure of the group.
Which is how historic financial collapses happen.
Yep.
If the principal auditor just blindly trusts the local auditors of offshore entities without analyzing their competence or the systemic risk they represent, billions of dollars of hidden debt can easily slip right into the consolidated whole.
And to prevent that exact scenario, SA 600 dictates that C.A. Tushar cannot accept the appointment unless his own direct participation in the audit is deemed sufficient.
He cannot just be a passive aggregator.
Exactly. To determine if his participation is sufficient, he is required to evaluate 4 highly specific criteria.
What's the first one?
First, he must assess the materiality of the portion of the financial information which he audits himself.
Okay.
If he is only auditing the parent company, and the parent is essentially a shell company, while 99% of the revenue is generated in subsidiaries audited by others, his direct financial footprint is likely insufficient to take the lead role.
He needs to have his hands on a meaningful percentage of the group's actual capital flow.
Precisely. Second, he must evaluate his degree of knowledge regarding the business of the components.
Even the ones he isn't auditing.
Even if a different firm is auditing a subsidiary, the principal auditor must fundamentally understand the economic drivers, the supply chains, and the regulatory environment of that subsidiary's operations.
Makes sense.
Third, he must assess the risk of material misstatements in the financial information of the components audited by the other auditors. Are those subsidiaries operating in highly volatile, high-risk sectors?
Are the component auditors experienced with those specific industries?
Right. Do they have a history of regulatory sanctions?
He is basically underwriting the competence and the risk profile of the participant auditors.
Exactly. And finally, the fourth criterion is the performance of additional procedures.
Meaning what?
Can C.A. Tushar perform additional overarching audit procedures on the components audited by others to artificially increase his level of participation and gain the necessary comfort over their numbers?
Okay, as your academic tutors, we recognize that recalling a 4-part list buried within an auditing standard can be incredibly difficult during a high-pressure compliance review.
Or a brutal exam.
Exactly.
Yeah.
So we have engineered a memory technique specifically for this SA600 litmus test.
I love this one.
Yeah, when you are determining whether you have the grounds to put your mark on a group audit engagement, you utilize the MARK mnemonic, the MIK checklist.
Let's explicitly break down the MARK framework.
Let's do it.
M represents materiality. What is the financial materiality of the specific portion of the group that you are auditing yourself?
Okay, M is materiality.
A represents additional procedures. Do you have the access and ability to perform additional procedures on the other components to amplify your participation?
A is additional procedures. Got it.
R represents risk. What is the inherent risk of material misstatement in the work being submitted by the component auditors?
R is risk.
And K represents knowledge. What is your fundamental degree of knowledge regarding the actual business models of the components you aren't directly auditing?
Materiality, additional procedures.
Yeah.
Risk, knowledge, the MARK checklist.
If CA Tushar evaluates those 4 pillars and finds them robust, he can confidently accept the engagement.
But accepting the job is really just the starting line, isn't it?
Oh, absolutely. Once he is in the role, he faces a profoundly difficult analytical hurdle: determining materiality for the consolidated financial statements as a holistic entity.
Right, and the source material lays down a very strict mandate here. Materiality must be computed for the group as a whole.
Yeah, you can't just piece it together.
Right. A novice auditor might assume you simply calculate the standalone materiality for the parent, calculate the standalone materiality for each subsidiary, and then, just add them all together to get the group threshold.
That is mathematically and philosophically incorrect.
You must compute a macro-level threshold based on the consolidated numbers.
And the reasoning behind this goes to the very core of why consolidated statements exist. This group-level materiality is the filter used to assess the appropriateness of consolidation adjustments.
Let's slow down and really dissect the mechanics of that, because the phrase consolidation adjustments can sound like abstract accounting jargon to anyone outside of a firm's technical desk.
I definitely can.
What are we actually talking about when we say we are adjusting the financials for consolidation?
We're talking about fundamentally altering the numbers to reflect economic reality over legal form.
Right.
There are 2 primary categories of adjustments we have to address: permanent consolidation adjustments and current period consolidation adjustments.
Let's tackle permanent adjustments first.
Okay, so when a holding company acquires a subsidiary, they pay a certain amount of capital. On the parent's standalone balance sheet, that payment sits as an investment.
Right.
But when you consolidate, you have to cancel out that investment value against the actual share capital of the subsidiary you acquired. You cannot show both the investment and the underlying equity of the subsidiary. That would be double counting the exact same value.
You're collapsing the legal transaction to show the underlying asset.
Exactly. But the amount the parent paid almost never matches the exact book value of the net assets they acquired.
There's always a premium or a discount.
Right. The difference between the purchase price and the net asset value results in a permanent adjustment. If the parent overpaid for the subsidiary, perhaps buying it for its market share or brand value, that premium is recorded on the consolidated balance sheet as goodwill.
And if they bought it cheap?
If they acquired the subsidiary at a distressed discount, buying it for less than its net assets, that bargain purchase is recorded as a capital reserve. This is a permanent structural adjustment. It lives on the consolidated balance sheet in perpetuity.
It is the capitalized premium or discount of the acquisition strategy itself.
Exactly. Then you have current period adjustments, which are vastly more complex.
Why are they more complex?
Because these involve the elimination of all intragroup transactions. Imagine subsidiary A manufactures heavy industrial turbines and sells one to subsidiary B for $10 million, baking in a $2 million profit.
Okay, simple enough.
On subsidiary A's standalone P&L, they recognize $10 million in revenue and $2 million in profit. On subsidiary B's standalone balance sheet, they have a $10 million asset.
Which is completely legitimate for their individual localized reporting.
Absolutely. But from the perspective of the master consolidated group, nothing economic actually happened.
The group just moved a turbine from one pocket to another.
Yes. If subsidiary B hasn't sold that turbine to an external third-party buyer yet, that $2 million profit is entirely unrealized. You cannot recognize profit for selling inventory to yourself.
Right, because if you allowed that, a failing company could just trade the same asset back and forth between its subsidiaries at higher and higher prices to generate infinite fictitious profit.
It would be massive fraud. Therefore, the auditor must execute a current period adjustment. They must eliminate that intragroup sale, eliminate the unrealized profit from the consolidated inventory valuation, and reverse that profit right out of the consolidated P&L.
I mean, the complexity of tracking those localized intragroup trades across 100 subsidiaries is staggering.
It's a nightmare.
And this illustrates exactly why CA Tushar needs that macro group level materiality threshold. It acts as the ultimate financial filter. If an error in calculating an intragroup transaction or a slight miscalculation of the permanent goodwill figure falls below that massive group-level materiality threshold, it might not require the principal auditor to demand a restatement or modify the overall audit opinion.
But if the consolidation adjustments are flawed at a level that breaches the macro threshold, the entire consolidated picture is distorted, and the auditor must intervene.
Furthermore, the principal auditor uses this group-level materiality to dictate the scope and rigor of the component auditors.
Right, that's crucial.
If the group materiality is set at 50 crore, and a component auditor is auditing a subsidiary using a localized materiality threshold of 100 crore, a severe risk emerges.
Oh, a massive risk. That component auditor might entirely miss financial errors that are immaterial to their specific subsidiary, but which are highly material when aggregated into the group consolidation.
So the principal auditor must force the component auditors to align their risk thresholds with the macro reality.
The interplay between the micro and the macro here is fascinating.
It really is. So we have assessed the components, utilized our MARK framework to underwrite the acceptance of the engagement, and calibrated our group-level filters for the structural consolidation adjustments.
We are making good progress.
But this brings us to a massive operational roadblock. Assuming we have accepted the audit and set our thresholds, we immediately face the reality of globalized capital.
Cross-border issues.
Yes. We have to audit foreign subsidiaries that are using entirely different financial languages. We have to bridge the gap across international borders.
And our source material addresses this through the case of Najib Limited.
Okay, tell us about Najib.
It is a listed Indian corporation that operates as a primary supplier to the United States building and construction market. The scale is immense. It has a turnover of 1.9 billion rupees, operates through 11 major business units, and controls nearly 1,700 branches spread across different countries.
1,700 branches. That kind of operational footprint creates a dual-layered nightmare for the auditor tasked with consolidation.
It really does.
We are dealing with differing accounting frameworks, the GAAP, generally accepted accounting principles, and simultaneously we're dealing with differing auditing frameworks, the GAS, generally accepted auditing standards.
Right.
We need to dissect these one at a time. Let's tackle the accounting framework first. Najib Limited is domiciled in India, which means the parent company prepares its master financials under Indian GAAP, or IND-S.
Okay.
But its vast network of U.S. components are legally required to prepare their local financial statements under U.S. GAAP. How does a principal auditor take two completely different accounting languages and merge them into a single, cohesive, consolidated statement?
The source material outlines two highly distinct methodological approaches here. The first approach is post hoc conversion.
Post hoc conversion, okay.
In this scenario, the U.S. component prepares its financial statements fully under U.S. GAAP, and the local U.S. auditor audits those statements under U.S. GAAP.
Right.
Those audited U.S. formatted financials are then transmitted to the parent company in India. At that point, the parent's management team must perform a massive retroactive conversion of those U.S. GAAP financials into Indian GAAP.
That's awful.
And then the principal auditor in India has the burden of auditing those specific conversion adjustments to ensure they are mathematically sound and suitable for consolidation.
From the perspective of financial mechanics, that post hoc conversion process sounds incredibly fragile.
It's very fragile.
I mean, if the parent's management team is executing a conversion adjustment from U.S. GAAP to Indian GAAP after the fact, aren't they introducing massive translation risk into the core financials?
Yes, absolutely.
It feels structurally identical to currency exchange risk in a massive Forex portfolio.
Oh, that's a great way to look at it.
The underlying assets of the Forex portfolio might be rock solid, but the actual process of converting the value of those assets back to your base currency at the end of the quarter introduces huge volatility and an enormous potential for misstatement due to conversion variables.
Your Forex portfolio analogy highlights the exact friction point of the post hoc method. You are not just translating currency, you are translating core financial philosophies.
Right.
You are dealing with fundamental structural differences in how inventory is valued under U.S. rules versus Indian rules. You are dealing with different timelines for how revenue is recognized and entirely different criteria for how long-term leases are capitalized.
It's not a one-to-one mapping.
Not at all. Attempting to retroactively patch a completed U.S. GAAP balance sheet to forcibly fit into Indian GAAP requirements is a highly complex, intensely manual, and incredibly error-prone process. The risk of material misstatement during the conversion itself is astronomical.
Which is exactly why the source material provides the alternative and arguably far superior approach.
Yes. The second approach is the implementation of a group accounting manual.
A group accounting manual.
Right. Instead of the U.S. component preparing their standalone financials and their local U.S. GAAP, they are instructed to prepare a secondary special set of financial statements directly on the basis of the parent's accounting policies, as comprehensively outlined in this group accounting manual.
Oh, so they do it from the start.
Yes. This manual is a master rulebook containing all the accounting policies and disclosure requirements consistent with the Indian framework used for the master consolidated financials.
You essentially force the subsidiary to speak the parent's financial language from day one of the reporting cycle, rather than trying to translate it after the fact.
It creates a significantly cleaner, structurally robust financial pipeline. The local U.S. auditor is then tasked with auditing this specific set of financials prepared under the group accounting manual.
Okay.
When those audited numbers are transmitted to India, the principal auditor simply reviews the manual's implementation to ensure it fully complies with Indian GAAP. If it does, the data flows seamlessly into the parent's consolidation software without the need for complex retroactive translation adjustments.
It completely circumvents the translation risk inherent in the post-hoc method.
Exactly.
The logic is unassailable.
Yeah.
It is like standardizing the data inputs across an entire, globally distributed, high-frequency trading algorithm.
Yeah, good analogy.
If you ensure every node is processing data in the exact same format before the trade is executed, you eliminate the latency and error of trying to normalize the data feeds after the fact. It is just structurally sounder.
Totally.
But wait, what about the second layer of this jurisdictional problem? The auditing framework itself.
Right, the GAAP.
The U.S. auditor is auditing the U.S. component, but how they audit, the actual methodology of their verification, their sampling techniques, their risk assessments, might be totally different from Indian auditing standards.
This is a vital conceptual distinction for anyone studying advanced corporate finance to grasp. Accounting standards dictate the what numbers you report and how you value them. Auditing standards dictate the how you systematically verify that those reported numbers are grounded in reality. The source material is unequivocal on this point. Normally, audits of consolidated financial statements are performed under Indian GSS, generally accepted auditing standards in India.
Okay.
In order for the principal parent auditor to legally rely on and refer to the U.S. component auditor's report, that component's audit methodology must correspond to Indian GSS.
The implication there is severe.
Very.
Even if the subsidiary uses the group accounting manual to perfectly solve the accounting gap issue. If the U.S. auditor utilizes an auditing methodology that falls short of Indian GAS requirements, for example, if U.S. standards require smaller sample sizes for physical inventory verification, or if they mandate less stringent protocols for independent third-party confirmations of trade receivables, the principal auditor in India cannot blindly rely on their word for the consolidated report.
They cannot.
The actual verification process must have parity.
The chain of financial evidence is only as strong as its weakest methodological link. If the auditing framework lacks parity, the principal auditor cannot achieve the level of significant participation we outlined under our MARK litmus test.
Right, the MARK test.
They would be forced to perform additional procedures themselves or potentially modify the audit report due to a scope limitation.
The structural rigor required is staggering.
It is.
I mean, we have spent an immense amount of time discussing the agonizing mechanics of consolidating these massive, sprawling foreign and domestic subsidiaries. We have mapped out materiality, acceptance criteria, consolidation adjustments, and cross-border gap translation.
Right.
But let's invert the entire premise for a second. What if a company doesn't actually have to consolidate them at all?
Ooh. Now we enter the territory of the consolidation carve-out. We are going to examine a massive, legally sanctioned structural loophole in the consolidation framework.
What is it?
The investment entity exemption.
The source material introduces us to a very specific corporate structure to illustrate this. Jambu and Sudharma Investments Ltd.
Okay.
They have a paid-up share capital of 1 crore, and they legally control a subsidiary called Investors Fund Management Ltd. The core business model of Jambu and Sudharma is entirely distinct from a traditional operational company.
How so?
Their major business is to pool money from investors. Specifically, the case notes they pooled 12 crore from a network of clients, and they deploy this money into various funds, shares, and debentures.
So the defining operational detail of Jambu and Sudharma is how they generate value. The profit they earn is derived solely from the capital appreciation of the prices of these shares or from investment income like dividends, which is then distributed back to their shareholders.
All right.
And crucially, the performance of all these underlying investments is continuously measured on a fair value basis.
So we have an auditor, CA Vardman, tasked with auditing Jambu and Sudharma. He looks at Section 129(3) of the Companies Act, 2013.
The big one.
Yeah. Now, in the realm of corporate governance, Section 129(3) is generally considered the absolute unyielding law of the land regarding corporate structures. It issues a statutory mandate. Where a company has one or more subsidiaries, it shall prepare a consolidated financial statement of the company and all subsidiaries in the same form and manner as its own.
The statutory law says, unequivocally, consolidate everything you control.
Exactly. However, CA Vardman is also evaluating the accounting standards, specifically IND AS 110.
Okay.
Paragraph 31 of IND AS 110 provides a massive structural exemption. It explicitly states that an investment entity need not present consolidated financial statements.
Wow.
Instead, it is required to measure all of its controlled subsidiaries at fair value through profit or loss.
But wait, from a legal governance perspective, if Section 1293 is a statutory act passed by the legislature dictating that a company must consolidate everything, how can an accounting standard issued by a regulatory board just provide an out?
That's a great question.
In corporate law, doesn't the statutory act always override the accounting standard? How does this exemption actually hold up in court? Can a company just legally ignore Section 129(3)?
The legal architecture supporting this exemption is brilliant, and it actually doesn't rely on an accounting standard magically overriding statutory law.
Okay, how does it work?
The legal supremacy here is embedded within the Companies Act itself, specifically under Section 129(6).
Section 119.
This section grants the central government the explicit power to, by notification, exempt any class or classes of companies from complying with any of the requirements of Section 129.
I see.
The Ministry of Corporate Affairs, utilizing this immense statutory power, issued notifications that directly aligned the statutory requirements with the IND AS 110 exemption for investment entities. It isn't a contradiction. It is a legally watertight carve-out authorized by the Act itself.
So the legal mechanism is unassailable. But let's dive into the core financial logic. Why did the government feel the need to create this massive exemption in the first place? Why let an entire class of companies off the hook for consolidation?
Because forcing an investment entity to consolidate actually destroys analytical value for the end investor.
How so?
You have to consider the economic reality of what an investment entity is. Think of a venture capital fund, a massive private equity firm, or a mutual fund.
Okay.
Suppose a massive venture capital fund takes majority controlling stakes, which legally makes them subsidiaries, in a highly speculative software startup, a nationwide chain of retail coffee shops, and a biotech pharmaceutical research firm conducting clinical trials.
I mean, those are completely unrelated operational businesses. They share no supply chains, no management synergy, and entirely different risk profiles.
Exactly. If the statutory law forced that VC fund to consolidate those entities under Section 129(3), the auditor would have to mash together the software-as-a-service subscription revenue, the physical coffee bean inventory, and the cash-burning R&D expenses of the clinical trials into one single, monstrous, hybridized, consolidated balance sheet in P&L.
What analytical value does that consolidated statement provide to the limited partners who invested in the VC fund?
Absolutely none. It is pure financial noise. The institutional investors in a venture capital fund do not care about the gross margin on a latte sold by one of the portfolio companies, nor do they care about the localized depreciation of the coffee machines.
Right.
They only care about the macro net asset value, the NAV, of the fund's overall equity stake in that coffee chain, which is structurally identical to how institutional investors view cap tables.
The investors only care about the fair value of the portfolio. By utilizing the INAS 110 exemption, Jambu and Sudharma avoids the costly, meaningless exercise of creating a bloated consolidated statement. Instead, they report their holdings as individual line items measured at fair value through profit or loss. If the coffee chain's equity value skyrockets due to a successful expansion, it simply reflects as an unrealized gain in the fund's P&L.
It provides a much cleaner, vastly more accurate picture of the investment fund's actual financial health and return profile.
It is a stunning piece of regulatory design that prioritizes economic reality over rigid legal form. But a holding company cannot just arbitrarily declare itself an investment entity to avoid the agonizing pain of consolidation.
No, you can't just opt in.
You have to rigorously qualify for the status. AS 110 sets very strict, unyielding parameters. And as your academic tutors in this masterclass, we have engineered a mental framework to help you instantly analyze the corporate structure and identify if it legally qualifies for this massive carve-out.
We call it the FCM checklist.
The FCM checklist is your definitive high-level guide to identifying an investment entity. Let's break down the components.
Let's do it.
F stands for funds. The entity must obtain funds from one or more investors, specifically for the purpose of providing those investors with investment management services.
Okay.
F is funds.
C stands for commits. The entity must formally commit to its investors that its sole overriding business purpose is to invest those pooled funds for returns from capital appreciation, investment income, or both. It cannot be operating a massive manufacturing plant on the side.
C is commits.
M stands for measures. The entity must systematically measure and evaluate the performance of substantially all of its investments on a fair value basis.
Funds, commits, measures. The FCM framework.
If we apply this to the Jambu and Sudharma case study, they pooled 12 crore from a network of clients that perfectly satisfies the F. They obtain funds from management.
Right.
They invest that money solely for price appreciation and distribute the subsequent profits. That satisfies the C. They commit to capital returns as their sole purpose.
Yep.
And crucially, they evaluate the performance of their holdings on a fair value basis. That satisfies the M. They measure at fair value. They successfully hit all three pillars of the FCM checklist. Therefore, CA Vardman must conclude that they legally qualify as an investment entity and are fully exempt from Section 129 consolidation requirements.
However, there is one critical, often overlooked caveat embedded in paragraph 33 of IND AS 110 that catches many analysts off guard.
What's a caveat?
A parent of an investment entity shall consolidate all entities that it controls, including those controlled through an investment entity's subsidiary, unless the parent itself is an investment entity.
Whoa, okay, let's translate that into a real-world corporate structure.
Yeah.
This means if a massive traditional manufacturing holding company decides to set up an internal venture capital fund as a subsidiary to invest in new technologies, that VC fund subsidiary doesn't have to consolidate the tech startups it buys.
Right.
But the ultimate manufacturing parent company still has to consolidate the VC fund, and by extension the startups, into its master financials.
Exactly. The exemption does not magically travel up the corporate chain. The carve-out dies at the level of the investment entity unless the ultimate parent company at the very top of the structure also passes the FCM checklist.
That is an incredibly crucial nuance for risk assessment. So if you hit the FCM criteria, you unlock the exemption.
But what if you don't?
If you don't, if you are a traditional operational holding company, you are mandated to consolidate. And when you do, you face the agonizing task of reconciling the granular, localized accounting estimates of every single subsidiary in your group.
Which brings us to a highly complex area of financial reporting, reconciling the ledgers. Specifically, the mechanical nightmare of depreciation across different entities.
Our source material provides an excellent multi-layered scenario to dissect this issue. We have a corporate group led by HCO Ltd., the holding company.
Okay.
They control two operational subsidiaries.
Right.
RCO Ltd. and ESCO Ltd. Now, HCO, the parent, has adopted the straight-line method of depreciation for its core assets.
Straight line. Got it.
ESCO, however, utilizes the written-down value method, also known as the diminishing balance method.
Okay.
And ARCO follows the straight-line method, matching the parent, but they completely fail to give effect to component accounting for their high-value assets.
Okay, we need to break this down piece by meticulous piece, starting with the divergence between HCO and ESCO.
The parent company is using straight-line depreciation. From a financial mechanics perspective, this means they depreciate the book value of an asset by the exact same uniform amount every single year until its estimated salvage value is reached.
It is a flat trajectory.
ESCO, the subsidiary, is using written down value, meaning they calculate depreciation as a fixed percentage of the remaining book value each year.
Right, which forcefully front-loads the depreciation expense, taking massive write-downs in the early years of the asset's life.
So as an auditor charged with consolidating these two distinct entities, you are immediately confronted with a massive methodological mismatch.
And the immediate visceral instinct for many finance students or junior analysts is to assume that uniformity is king. They assume the subsidiary must be forced to change its depreciation method to match the parent's straight-line method so that the consolidated financials are mathematically consistent.
But that instinct is fundamentally incorrect under the current reporting frameworks, isn't it?
It is. It comes down to a vital structural distinction codified in IND AS 8. The profound difference between an accounting policy and an accounting estimate.
I want to really drill into the philosophy of this, because allowing different depreciation methods to coexist across a single consolidated group feels intuitively wrong.
Really?
Yeah, doesn't that distort the consolidated P&L? It feels like a private equity firm using entirely different discount rates to calculate the net present value for multiple assets that exist within the exact same asset class and risk profile. You are bending the mathematical parameters to alter the final valuation.
I see.
Why does the regulatory framework allow different depreciation methods to contaminate a single consolidated statement?
Your private equity discount rate analogy touches on the inherent risk of valuation manipulation, but we have to look at what depreciation actually represents in economic reality.
Yeah.
An accounting policy is a foundational principle. For example, a policy decision stating, we capitalize all software development costs instead of expensing them immediately. An accounting policy must be rigorously uniform across a consolidated group, which is exactly why the group accounting manual we discussed earlier is so vital.
Right.
But under the rules, depreciation is not classified as a policy. Under IND AS 8, the selection of the method of depreciation is classified as an accounting estimate.
An estimate of what exactly? What is the auditor trying to approximate?
It is an estimate of the expected pattern of consumption of the future economic benefits embodied in that specific asset.
Okay, let's ground this in a physical reality.
Sure. Imagine the parent company, HCO, operates highly sensitive, heavy machinery in a climate-controlled, dust-free manufacturing facility. Because of the pristine environment, the machinery degrades at a perfectly even pace over 10 years.
So straight-line depreciation is a perfect mathematical match for that uniform consumption pattern.
Exactly. Now imagine ESCO, the subsidiary, operates the exact same model of heavy machinery, but they deploy it in an open-pit coal mine exposed to harsh, corrosive weather and abrasive materials.
That machine is going to suffer massive, accelerated wear and tear in its first 2 years of operation.
Right. And its economic output will drop sharply as it requires constant part replacements later in life. The written-down value method, which aggressively front-loads the depreciation expense, is a far more accurate reflection of ESCO's localized consumption pattern.
The implication there is profound. If the auditor forced ESCO to abandon the written-down value method and adopt the parent's straight-line method purely for the sake of cosmetic consolidated uniformity, the resulting consolidated balance sheet would actually be less accurate.
It would cease to represent a true and fair view.
You would be actively under-depreciating the mining equipment in those brutal early years, artificially inflating the group's consolidated asset value.
Exactly the case. The regulatory framework recognizes that economic reality supersedes aesthetic uniformity. As long as the expected pattern of consumption is demonstrably different based on the operational environment, different methods of depreciation can and must coexist in a consolidated statement.
That makes sense.
The method, once judiciously selected based on the asset's physical reality, should never be arbitrarily changed just to make the consolidation spreadsheet look cleaner. So HCO and ESCO utilizing different methods is completely acceptable, provided the underlying economic consumption patterns justify the divergence.
That fundamentally reframes how we must look at depreciation. It isn't a rigid rule. It is a highly localized economic estimate.
Yep.
But that brings us to the third entity in this scenario, ARCO Ltd. Now, ARCO uses the straight-line method, perfectly matching the parent company.
Right.
So on the surface level, they look perfectly compliant. But the source material explicitly notes that ARCO does not give effect to component accounting of depreciation in respect of high-value assets. What does that mechanical failure actually mean in practice?
It means they are in strict violation of compliance. This is a severe breach of AS10, or IND AS16, regarding the treatment of property, plant, and equipment.
Okay, what's the rule?
The regulatory framework for component accounting mandates that each individual part of an item of PPE, assuming that part has a cost that is significant in relation to the total overall cost of the item, must be segregated and depreciated separately over its own specific useful life.
Let's construct a strict financial valuation analogy to visualize this. It is structurally identical to how a real estate investment trust, a REIT, handles property valuation.
Quite perfect.
A REIT must meticulously separate the underlying land value from the commercial building value on their master balance sheet.
Yeah.
Why? Because the land fundamentally retains its value over time or actively appreciates, while the physical commercial structure sitting on top of that land degrades, requires maintenance, and ultimately depreciates. If the REIT just lumped the land and the building together into one massive, undifferentiated asset block and depreciated the entire thing uniformly, their net asset value would be artificially massively deflated over time. The math would be fundamentally broken.
That is a flawless structural analogy. Component accounting takes that exact logic and applies it to complex industrial assets. Consider a logistics subsidiary purchasing a massive commercial jet for $200 million.
Okay.
Under outdated accounting models, you might just depreciate the jet as a single asset over 25 years. But under AS10 component accounting, that is illegal.
Why?
Because the core airframe might legitimately last 25 years, but the massive jet engines might burn out and need complete replacement every 7 years. The interior cabin seating and electronics might need total refitting every 5 years. The engines in the cabin are highly significant, high-value components of the total $200 million asset, and they have vastly different consumption patterns.
So under AS10, the logistics company is forced to break that single $200 million asset down into its constituent parts on the ledger. They depreciate the airframe over a 25-year schedule. They set up a separate 7-year depreciation schedule for the engines and a 5-year schedule for the cabin interior.
They maintain separate, highly granular depreciation ledgers for the major components.
And because Arco Ltd. completely failed to do this, perhaps they just lumped a massive multi-million-dollar manufacturing plant and its highly degradable, short-lived internal conveyor systems into one massive asset block and depreciated it all uniformly over 20 years. Their standalone financial statements are fundamentally flawed.
Yes, they're drastically underdepreciating the high-turnover components in the early years.
And therefore, as the principal auditor of the parent company, AgeCo, you cannot legally consolidate Arco's financials as they are currently presented. You must demand a massive retroactive adjustment to separate those components, or you must modify the master audit report.
The fact that they are using the correct straight-line method is irrelevant. Their failure to apply component accounting invalidates the underlying math of the asset valuation.
It is all about capturing the true granularity of the economic reality, which provides the perfect transition into the final critical area of our masterclass, trimming the fat from the final report.
It's a fun one.
Because once an auditor has gathered all the constituent components, applied the cross-border GAAP translation frameworks, rigorously checked the investment entity exemptions, and painstakingly reconciled the granular asset depreciation estimates. The final step is to actually publish the consolidated financial statements and their accompanying notes to the public markets.
Right.
And the central question becomes, out of the millions of data points generated by a massive corporate group, what actually makes the final cut for the public disclosure?
Our source material illustrates this dilemma through the case of ABC Limited. This is a holding company that maintains a 51% controlling equity stake in BBB Limited and a 63% stake in TTT Limited. When the end of the fiscal year arrives and it is time to consolidate, the management team of ABC Limited takes a very specific approach. They take every single granular piece of information, every tiny localized disclosure, and every explanation contained within the local notes of the subsidiary's standalone financials, and they indiscriminately cram all of it into the master notes of the consolidated financial statements.
It is a massive, unfiltered data dump onto the public markets.
Exactly. But the principal auditor fundamentally disagrees with this approach. The auditor pushes back aggressively, stating that only information and explanations that are genuinely relevant at the macro group level should form part of the consolidated notes.
Based on Section 129.4.
Yes. The auditor's stance is firmly rooted in the principles derived from Section 129 of the Companies Act, supplemented by specific clarification circulars issued by the Ministry of Corporate Affairs.
Let's critically examine the auditor's view here. Why intentionally drop verified financial data? In modern capital markets, isn't the operating philosophy that more transparency is always better?
You'd think so, but no.
If a subsidiary has incredibly detailed disclosures about their localized unutilized funds or their specific foreign exchange expenditures down to the dollar, why actively strip that data out of the consolidated master report?
Because of context.
Hiding that granular data feels structurally identical to a massive venture capital holding company outright refusing to provide the individual cap tables of its various startup subsidiaries to its primary institutional investors. It feels like a deliberate attempt to obscure the localized micro risks from the market's view.
Your cap table analogy perfectly represents the mindset of a microanalyst trying to evaluate a single node in a network. But consolidated financial statements are explicitly engineered for macro analysis of the entire network.
Okay.
What management is doing in the ABC Limited case leads to a highly dangerous phenomenon known in financial reporting as information overload.
Information overload. The concept that too much unfiltered data actually destroys clarity and obscures the vital signal.
Consider the reality of a global multinational conglomerate with 150 distinct operating subsidiaries. If the consolidated master report was forced to include the granular, localized details of every single subsidiary's payable dues under the Micro, Small, and Medium Enterprises Development Act, the MSME Act, the consolidated notes wouldn't be 50 pages long. They would be 5,000 pages long.
Right.
The actual existential systemic risks of the holding company, their macro leverage ratios, their consolidated cash flow constraints, their aggregate debt covenant compliance, would be completely buried under a mountain of localized, highly immaterial noise. The fundamental goal of consolidated notes is macro clarity, not micro data dumping.
The regulatory framework understands that human attention and even algorithmic processing is finite. It actively allows and actually encourages management to trim the fat from the disclosures. Now, IND AS 110 doesn't provide a blanket negative list of everything you can ignore. But based on the Ministry of Corporate Affairs circulars, the source material explicitly details 7 highly specific disclosures that are legally required in separate standalone financial statements, but which need not be included in the master consolidated financial statements.
And as your academic guides through this complex material, we know that attempting to memorize a random, disjointed list of 7 technical exclusions for an exam or a rapid compliance review is inefficient.
Very inefficient.
Therefore, we have synthesized these 7 disparate points into a highly effective 5-letter mnemonic that categorizes the underlying financial concepts. We call it the BUMIF exclusion list.
BUMIF.
Standing for Balancing Unutilized Money in Finance.
Let's systematically break down the BUMIF checklist for consolidated note exclusions.
Starting with B.
B stands for bonus shares. You do not need to disclose the highly specific source from which bonus shares are issued by the local subsidiaries. For example, whether a subsidiary capitalized its localized profits, its free reserves, or its securities premium account to issue those shares.
Right, because it is essentially an internal equity restructuring at the micro level that doesn't impact the macro cash flow of the consolidated group.
Which stands for unutilized monies.
Yes. You are not required to disclose the granular, localized details of all unutilized monies arising out of specific public issues made by individual subsidiaries. Nor do you need to disclose the exact form in which those unutilized funds have been temporarily invested by the subsidiary.
Because at the consolidated master level, treasury management and liquidity are viewed holistically across the entire group, not on a subsidiary-by-subsidiary basis.
Exactly. M stands for MSME Act disclosures. As we previously illustrated, you do not need to aggregate and report every single delayed payment to a micro-supplier across a network of 100 subsidiaries.
A delayed payment to a local vendor by a subsidiary is a localized working capital management issue. It is not a group-level systemic risk that threatens the holding company.
Right. I stands for investment statement. You do not need to include the incredibly granular, exhaustive statement of investments showing the exact names of every single corporate body where shares or debentures are held by every subsidiary, separating trade investments from non-trade investments for each entity.
Once again, the macro fair value of the entire group's investment portfolio is what drives valuation for the consolidated entity, not the micro ledger of every single localized trade.
And finally, we have F, which stands for the foreign exchange trio. The source material lists 3 distinct, separate foreign exchange items that can be safely excluded, so we bundle them under the F pillar.
What are the 3?
First, the granular expenditure in foreign currency on account of royalties, technological know-how, professional advisory fees, or localized interest payments. Second, the highly specific ratio and value of imported raw materials and spare parts consumed by a subsidiary versus indigenous materials consumed. And third, the specific amounts remitted during the year in foreign currencies on account of dividends, including the specific number of non-resident shareholders and the exact number of shares held by them in the subsidiary.
The reason we bundle these foreign exchange items for exclusion is rooted in macroeconomics. At the master holding company level, intragroup foreign currency flows frequently cancel each other out.
Yeah, precisely.
A subsidiary in Europe paying royalties in euros to another subsidiary in Asia is completely neutralized during the consolidation process. What matters to the analysts evaluating the consolidated group is the net macro hedging strategy and the aggregate currency exposure of the entire corporate web against global currency fluctuations, not a single subsidiary's localized ratio of imported raw materials.
So we have the BUMIF framework: bonus shares, unutilized monies, MSME disclosures, investment statements, and the foreign exchange trio.
If you identify these highly granular items on a subsidiary standalone balance sheet, you know with absolute certainty that you can safely trim them from the consolidated notes to prevent information overload.
It is an essential filtration mechanism. It ensures that consolidated financial statements remain a clear, readable, and highly focused diagnostic tool for evaluating the macro health of the corporate group.
Well, we have covered an immense expanse of technical terrain today.
We really have.
As your specialized academic tutors, our overriding goal was to equip you with the advanced structural frameworks required to decode any consolidated financial statement or to dismantle any complex audit case study you might encounter in your professional career.
We initiated this masterclass by mapping the crucial materiality thresholds, utilizing our 10 to mention, 20 to direct rule to separate passive transparency from active governance.
We rigorously evaluated the principal auditor's liability and risk matrix using the MARK litmus test.
We systematically navigated the immense risks of cross-border gap translation, highlighting the structural superiority and efficiency of implementing a master group accounting manual.
We uncovered the massive, legally authorized statutory loophole for investment entities utilizing our SCM checklist, detailing exactly why fair value reporting mathematically trumps consolidation for venture capital funds.
We untangled the complex nuances separating accounting estimates from accounting policies and demonstrated the absolute mathematical necessity of AS10 component accounting for accurately valuing high-value industrial assets.
And we concluded by learning how to surgically trim the fat from consolidated notes to prevent dangerous information overload, applying the BUMIF exclusion list.
We want to stress that these are not just abstract regulatory rules to memorize for an exam.
Definitely not.
These are the actual functioning financial mechanics that dictate how global corporate wealth is measured, how it is legally verified, and how it is ultimately presented to the public capital markets. If you master these frameworks, you master the hidden language of high-level corporate finance.
As we conclude this session, I want to leave you with a macro-level question to deeply consider, something that builds upon the regulatory architecture we have deconstructed today, but pushes your thinking beyond the immediate text of the rules.
Okay, what is it?
We have seen firsthand how consolidation rules are meticulously, deliberately designed. But we've also seen how they continuously evolve to carve out massive structural exceptions, like the investment entity exemption, and how they actively encourage management teams to trim highly granular data from the final notes to avoid information overload.
The BUMIF exclusions acting as a massive data filter.
Exactly. Therefore, the question for you to explore is this. As global corporate structures become increasingly decentralized, relying on unfathomably complex webs of special-purpose vehicles, offshore entities, and cross-border subsidiaries, at what point does a consolidated balance sheet fundamentally cease to reflect the true systemic leverage and localized hidden risks of that corporate web?
That's a profound question.
At what exact point does the regulatory permission to trim the fat and apply statutory exemptions completely transform a consolidated report from a rigorous, objective financial diagnostic into a highly curated, thoroughly sanitized presentation of a holding company's most favorable, market-pleasing assets?
It brings us right back to the central conflict we established at the very beginning of this session.
It does. We rely on these group audits to act as a flawless, penetrating X-ray of the corporate body. But the more complex the group structure becomes, and the more localized granular data we intentionally trim out of the final consolidated picture in the name of clarity, the more we have to critically wonder if the X-ray machine is actually capturing the underlying systemic disease, or if it is just taking a highly engineered, very flattering picture of the surface.
Something to think about.
Thank you for joining us for this masterclass on group audits. Keep these powerful frameworks firmly in mind the next time you analyze a multinational holding company's annual report, and we will see you next time.